Let's talk a little bit about the state of the U.S. economy now. Big week for economic data. We've got consumer confidence just out. We've also got GDP numbers set to drop in just a couple of days. Shannon Seery is an economist over at Wells Fargo, and she joins us now to talk about the outlook for the U.S. economy. And Shannon, let's start with a chart that really jumped out to me in a recent note you guys published, which was that cushion of savings, that excess savings that households are sitting on. As you think about the second, third quarter, even into 2022, how do you expect those savings to get wound down? Where are they likely to make their way in the economy?
Sure. So just to give a little bit of context, we're currently estimating that there's about $1.8 trillion in excess savings in the economy right now on households' balance sheets. So that's data through February. We do expect this to pick up in the next few months as the additional stimulus feeds through household balance sheets, and we're estimating it to reach as high as almost 2.5 trillion. So really an ample amount of savings out there that consumers can tap as the economy reopens and that service sector really picks up. So in terms of where we're expecting this to show up, we are expecting consumers to draw some of it down, but not nearly all of it. So that does present an upside risk to our consumer spending outlook. But what I would say is we definitely expect a lot of it to take place in the service sector as, pent-up demand for many services that consumers haven't been able to consume over the past year, really is unleashed as the sector reopens.
The term excess savings is always interesting to me because I think from a macro perspective, I get that. But from a personal sort of household budget perspective, that excess to many people is necessary savings, right? They want to have that cushion. So if indeed people are not going to draw down all of that savings from a macro perspective, is that a good thing that, that households, people like to trot out that number from a few years ago that, 40% of households would not be able to come up with $200 in cash. It's actually in cash. A lot of people said they could borrow that money. But in any case, people need a cushion, right?
Yeah, that's right. And I mean, our forecast doesn't necessarily have a large drawdown in this savings. So by the end of this year, we still expect about 2 trillion of it to be sitting on household balance sheets or, being used for other purposes. So the way that it's calculated is really an accumulation of a flow. So there's no real estimate to date that lets us say if it's really sitting there idle. So it could have been used to pay down debt, as some survey evidence suggests, as well as some consumer credit data, or it could even have found its way into the stock market over the past year. So consumers could have deployed this cash, but I think you bring up a really good point that even after the crisis is behind us, the service sector's reopened, we're back to some semblance of normal. I think that consumers are going to hold on to a little extra cushion after this year and this really, unprecedented crisis that we faced.
Shannon, while consumers have this cushion, this savings cushion, I think we could all agree that GDP growth is going to slow down later this year, perhaps slow to a crawl next year. When you run your models at Wells Fargo, does 1% to 2% GDP growth next year, does that turn negative with higher taxes?
So we're not presently expecting, negative GDP growth next year, or not even necessarily a huge slowdown. So we're still expecting a pretty healthy pace of growth next year. I think you bring up the good point that this year is the expected pop in both consumer spending and overall GDP. And obviously, it's kind of a sugar high from stimulus payments, the reopening of the service sector, consumers really being able to get out there again. So as that wears off, yes, there's certainly a risk that growth will slow. I don't think that necessarily the tax hikes at this point is really something that's going to weigh on growth in the next year or so as we, find ourselves on firmer footing coming out of the crisis. I think we're really bullish and optimistic for the consumer spending outlook. And with consumer spending being about 70% of real GDP, that should really help, growth into next year as well. And, it ties back to the savings discussion. If households really are sitting on all this cash and they decide to deploy it, whether that's in the services sector, paying down debt, hitting the stock market, those are all positives for the U.S. outlook, in our opinion.
Shannon, we haven't talked about the Fed yet, and I feel like we should, even though, of course, they're not going to change anything at the culmination of their meeting tomorrow. But I mean, the inflation discussion really does seem to be heating up. We're looking at input costs that really are on the rise, whether you're looking at agriculture, whether you're looking at other types of commodities. What effect do you think that's going to have on inflation? And is it going to be a less transitory effect, perhaps, than the Fed is factoring in?
Right. So our latest expectation is that you do have some of this price pressure building, particularly in the manufacturing sector, as you just mentioned, with those higher input costs. And businesses are really are reporting that they're at a point that we haven't seen in about a decade in terms of them, maybe increasing their own prices. So, we're definitely at a turning point for inflation. And we do expect inflation to pick up this year. Obviously, there's those low base effects from last year that'll help the year-over-year comparisons. But even past that, we are expecting inflation to be higher. We don't expect it to necessarily be at a point to test the Fed just yet. The Fed is going to look for a continued rate of above 2% for some time, until they can really see that it's not that transitory bounce before they remove accommodation from the markets. And we're not necessarily expecting them to see that well into our forecast through 2022.
All right, Shannon Seery is an economist at Wells Fargo. Shannon, thanks so much for jumping on, talk a little bit about the U.S. economy today, and we'll talk soon.